right, guys, I'm Holly Haven with Haven Home Team, and I am here today with Josh.Waters with CrossCountry Mortgage. How are you doing today, Josh?
Good, Holly. How are you?
Awesome. All right. I'm super excited to dive into this because there's so much conversation right now about interest rates. Interest rates are high, right? A lot of our buyers are kind of waiting. And you brought some really cool attention to some of the interest rates and options that buyers have right now. And I thought it was gonna be fun to kind of share, let people see what the options are, because when you're in kind of a market that you're not sure about, then, there's more questions than answers. So I'm excited to share what you guys have put together and what you can offer to buyers right now.
Well, very cool, Holly. Thanks for asking. Yeah, and first of all, thanks for having me on. Yeah, you're kind of hitting on some major pressure points for everybody when we're talking about rates and, should I wait? When are they going to come down? Is there a housing bubble? All these different things, because that's kind of the narrative that I'm hearing that. Are you hearing that too?
Oh, it's constant. People, we don't have a crystal ball. We don't know what's going to happen. We have some ideas that interest rates are going to come down, maybe the end of Q1 2024, but that's a long ways away. If you need to buy a house or you're in the market to buy a house right now, there's a lot of uncertainty. So I think, buyers being well educated about what the market is doing and about what the options are.
Yeah, so I put together a couple of things that will kind of help people reset their minds, because I think over the last couple of years, I'm sure you would probably agree that there's been kind of an unfair bar that's been set, or a mindset that has been put in place, because we've had these crazy low, stupid rates and 2% and 3% that realistically is not normal, nor probably will it ever be again. Would you agree?
Totally agree. It's kind of that false sense of reality almost, because they were low for so long. Even after 2001, right after 9/11, we had such low interest rates. And so now we kind of have forgotten that our historical average really is closer to that 5 to 6% mark. So we're at that 7 to 8 right now, which feels really uncomfortable. So that's what I really liked about what you were showing me when we looked at this spreadsheet or this slideshow last week, is it really takes everything into account, because your house may be your largest asset, but it's not necessarily the one that's costing you the most, especially in interest.
This is very true. Yeah, it's what we call your blended rate, right? Because you mentioned, things that are a way higher than what your housing interest rate is. And yes, interest rates right now, and don't quote me on the rate, but they're in the 7 to 8%, which has people really uncomfortable. And so I think it's important to kind of wrap our heads around what their whole blended household rate is, because you're gonna have credit cards that are in like the 20s. Maybe your car is in the high, maybe low teens, high, single digits. And there's all these things play a factor in what your household budget is. So I'm going to go ahead and share my screen if that's okay. And we can kind of just take a look at these little ahas that we kind of came up with to help buyers put things a little bit more in perspective. So again, we call this the blended rates and helping, move up buyers. So a move up buyer, you're familiar with the term, I'm sure. People, first time home buyers, they're in their first house, and they're going to probably be in there for, on average between 5 to 7 years, I think is the number, right?
Yep.
So stepping up to that bigger house, like there's strategies, a way to accomplish something like that without having to worry about, do I need to make more money? Can I actually afford something like that? So what I put together is kind of really going to help touch on a lot of those things. So I'm going to go ahead and dive in really quick. So I shared the screen with you last week, and this is a good kind of like a big aha that we had that we were looking at. Basically what it is, if you look at the top piece up right here, this is the personal savings rate of most in the country right now. Now, these big spikes that we're going to look at right here, what these big spikes indicate is that's when we all received those stimulus checks during COVID. You remember those?
I didn't get one, but yes, I do recall.
Yeah, most Americans did, and so the savings rates, if you look at these numbers right over here, and this is shaded areas, kind of indicates when COVID kind of came out, and really started. This first one obviously is our first stimmy check. I like to call it stimmy check. And so it went up. And so obviously savings are going to go up during that, because there's an injection of funds across the board. Well, if you look at the bottom screen right here, these are your credit card balances, right? Naturally, like as people are spending money, again, we're talking about blended household interest rates, and credit cards are a major factor in that. If you look over here, like everyone did a great job. They got that stimulus check, and the first thing that they did, what they do, they went and paid down those credit card debts. That's the smart thing to do, and really a really great thing that they did. So you start seeing credit card balances kind of taper down because people are being smart with the money. But there's also a big factor that's in play why credit card balances are low. Everything was shut down, so there was not a whole lot to spend money on. Everyone's kind of Netflixing and chilling and doing the whole thing and not going out. Right. So there's not a whole lot. So as we travel down, the credit card balances stayed low, and then we got another stimulus check, right? And so it didn't go up as much because they just instantly spent that money. They're like, you know what? I'm not going to go ahead and do that. I'm going to go ahead and spend it. I'm going to go have fun, right? And then right behind it, we got the third stimulus check, and people had already kind of starting to get accustomed to, okay, is there going to be another one? We've already gotten 3. Is there going to be a 4th? I'm not going to worry about my credit card debt, and I'm just going to keep living the adjusted lifestyle that I just came across. Plus, what happened here during this time frame? Everything opened back up, right? People are being more active. They're going out there, they're shopping, they're doing all the things. Amazon is blowing up like crazy. I mean, I think I know my Amazon driver's name personally, and we hang out and barbecue now because he was at my house so often. Yeah. Same boat.
Yeah. Oh yeah. At least one delivery a day, or we assume the Amazon driver's not okay.
I know. You call in, send the bat signal, say, "Where's my Amazon?" and "Are you okay?" We do a well check.
Exactly.
And right around this section right here, this is where everything opened back up. People are out there shopping again. They've got their new life. Not saying new lifestyle, but they're excited. No one likes to be cooped up in a house, and when they get a chance to get out and be more active, they're going to be more active. The downside is up here as we're looking, there's this big spike up here, the last stimmy check. Well, people didn't put it back in there. They didn't pay down their credit cards. They were out there having a good time because they were cooped up. Mm-hmm. And so savings started to go down at the exact same time that credit card balances are going up because they just needed to do something.
I think there was a lot of travel. A lot of people, once the world opened back up, people immediately started traveling. And that's one of the big things that Americans do put on credit cards is their travel funds. So I think that was a big impact, along with the economy itself, right? Eggs and gas expense, everything going up. And so you're kind of starting to feel that strain, and you start to put a little bit more on credit. And now we kind of see where we are today.
Well, yeah, you think about it, the whole premise behind credit cards, they're a fantastic tool. And that's what they should be considered as a tool. Like you said, travel. A lot of folks put things on credit cards because they're going to rack up points because there's benefits. And if you manage it correctly, they can be a fantastic asset to have. And like I mentioned, as a tool to, further yourself down. As long as you ended up paying down where you need to pay down instead of just the minimum payment. Well, this graph kind of shows that that's what folks were doing because we weren't seeing a whole lot of delinquencies, and we can go over credit another time, but people were just kind of just maintaining the minimum balance. Well, when you maintain just your minimum balance, you're not attacking the principal really. And then so that money keeps continuing to grow. And at the same time, what happens is you see this 14% down here. It's kind of muddled up in the numbers here, but as your credit card balances increase compared to the limit that you have on that credit card, the interest rate starts to go up too, because you become your risk is higher. And so they're going to adjust your interest rate. So as they start going up, now we're up here in, north of 22%, and we're not at that 14% anymore. So trying to pay down a card with your fixed income, if that's the case, on something that has 22% is a tall piece. It's a very tall order to fill, and people just kind of got underwater with it, So we go to the next one here. The other side of the coin, which was awesome during the 2 and 3% rate time, was we had this massive equity, boom, just huge in value. I know my house almost doubled.
Right.
And did you see the same thing?
Oh yeah. Yeah. Across the market. I mean, you could almost project 150 to 250,000 as kind of a baseline. And then everything above that was just like you said, we have many properties that actually doubled in about an 18-month period.
Yeah. It's wild. I mean, granted, if you bought during that time, and that's who this video is kind of geared towards, it's to them, but it's also for people that are looking to get into the market. But if you bought during that time frame, you are literally sitting on what could be kind of like a gold mine in equity in your home. And that's what this slide shows, is that the average amount of, when I say loan to value, we're actually talking about your equity in your home compared to what you actually owe on the house. So as you can see here in 2022, is 42% was your average loan to value, which means you have almost 60% worth of equity in that house. That is massive.
Yeah, it's unheard of. Statistically, this is not what our market has normally been, right? Unless somebody really stayed in their house 20 plus years, which is not our average. Our average is 5 to 7, like you mentioned earlier. So we don't normally see numbers like this on the equity in a home. This is definitely a gold mine line for a lot of people.
In such a short period of time too, like you just mentioned, like people that have been in their home for 20, 25 years, they have that equity in the home because they paid down the loan, not because of the market that we're in. So there's huge opportunities, my point with this, right? So let's just get to the next one here as we're going to talk about. All right. So we're going to talk about, we talked about that whole blended interest rate side. And do you really have a 3% rate? That most right now that bought during that time or refinanced during that time, they're sitting on a 2 3/4, 3.5, or whatever it is rate. And they're like holding on to it like they're just handcuffed to it.
Yeah.
And I like to say the words handcuffed because it's like you're constrained, like you're so fearful because of that. You don't want to let go of it. Well, let's look at all the other things that we have. And I'm going to point over this way because this is where my screen's at as we're going to describe this, is that your blended rate calculator here shows like if you have a mortgage, that's at 3%. We got all those other list of items. We talked about credit cards being in the 20s. This is just a description or kind of a template to look at. So your blended household rate, if you're looking at this scenario here, you're looking at 6.331,
right,
not a 3%, right? We like to only look at the big things in our life, but when you really start adding things up, that's where the big light bulb starts to go off.
Yeah.
Right. And so getting to the next slide here. So here's some options that we want to look at when looking at the consolidation of your debt to purchase a home. So look at the top here. We got 3% right here. We talked about most people have right now. And I didn't update this, but today's rate, obviously we're in between the 7s and the 8s. But let's just say we're at 6.75 as a description. Okay. They purchased their house, about 6 years ago for 500. And their original loan amount, if they put 20% down, is about 400,000 when they started that loan. As we talked about too, with the values increasing over the last couple of years, let's just say their value is now at 695, which is pretty average. And they paid down that loan a bit because it's not 400. Now they're at 343. That's just with their regular payments they've made over the last couple of years. Let's just say it was going to take about $35,000 to sell that house with a commission split, for your agents on both sides and just, anything that's outside there for closing costs. So they're going to have about an equity of about $317,000 to purchase a new home. This is the move up scenario that we talked about earlier. On average, your closing costs being right around $12,000 to purchase the new home. And so they have this available balance of about just over $300,000 to purchase, to move up to that house that maybe they really wanted initially, but they were doing their first home and a starter home. And they said, let's just start on a very modest scale, but now we're ready, right? Let's move up to that next one. So they say they want to look at a house that's about $850,000. Mindset says, well, I just made $300,000 on my house. I want to keep my payment low. So I'm going to throw that $300,000 as a down payment on the new house to keep my payment low. That's kind of the same narrative that you normally hear with buyers?
Absolutely. It's the first thing they want to do is take that whole amount and push it over. And for many people, that works perfectly. For the scenarios that we're talking about, for the average American right now with increased consumer credit, what you're about to show is it's huge.
It's a huge eye opener, right? Yeah. So if we look at just this, straight up math, purchasing 850, let's say they, conventional theory says throw 305 at the down payment. So they have a new loan amount on their upgrade of 545. Well, if you look up here, we're only talking, when I say only, we're only talking about $145,000 difference compared to the payment they had on their house they're departing from. Okay? Right. That's their loan amount. So this is a tall piece to swallow because when you look at the math on this with a 6.75% rate on a $545,000 loan amount, your payment's $2,500, a little over $2,500 more for that house. That's a big chunk to swallow, and most can't do that, so they're going to stick, right? So let's take a look at an option, a strategy that we can do. So if we take, and this is the slide just before, we're going to have all this list of debts that they have, their current credit cards, their, if they have a car loan in here or whatnot. And let's just say that whole balance equates to that they owe on those things right around $100,000. Well, if they're increasing their household and they're going to move to that next one, again, this 2572, which is their new proposed mortgage payment on that upgrade. Again, it's hard pill to swallow because most people don't have that in their budget to increase their outgo every month by that much without having, of course, like a pay raise at their job or something changes within their life, right? Income wise, money in. Well, here's a strategy. What happens if we take this $100,000 that we owe on all these little things right here, because they add up? I know I had some, I did this exact strategy myself.
Well, and you look at that monthly payment over there, right? You have what is that? $2,900 a month, give or take payments. Those are not paying off credit cards.
No,
not really making a dent in those credit cards, right? Like we're just paying that almost on a recurring basis, like we have another bill to pay every month that's not actually going away.
Well, and if you're a lot like me, and I like to do this, but I also I try and pay attention, but Most people have like a set it and forget it kind of thing. They know what they owe every month, and they make that amount and that payment, and they set it and they forget it. Most people don't like to look at their bank accounts because it freaks them out. So let's look at the strategy. If we really want to move up, let's take that $100,000 that we owe on all these little things right here that's really racking up interest like crazy, and we're not really making a whole lot of headway with them. Instead of putting $300,000 down, maybe we took 100 and we paid off those items. That same house, exact same scenario, 6.75% rate as an estimate at a $540,000 loan amount. That house, that $850,000 house that they really want, is only going to cost them $286 a month more than what they're currently paying right now. Do you think that most people would be like, oh, you know what? I can spend another $280 a month on the house I really want?
Right. When you're not paying off all this other stuff. Now, here's the thing that I think hits most Americans really hard. This is awesome. And I think a lot of people don't realize it's even, they don't even think about it, right? It's just not an option. We have these credit cards over here and they're very different than this home equity cash and payment that we're playing with. But what happens is spending habits don't always change. So that's where, somebody taking this and using it as an opportunity, using it as the way that it should be utilized, is now we've got to change those consumer purchase habits, not use the credit cards. Right. That's where you get yourself back in trouble again. Where now you need this equity again. Now you need to go pay those off again. But this is such a huge benefit because this does not change their monthly output at all. We're talking $286 different, but puts them in a better place. You're making headway on that mortgage every month, where really when you're paying those credit cards, you're making almost no headway at 24% interest. You can't make a big dent.
Well, yeah. I mean, a lot of times what happens too, Holly, is that when they get, and the weight of credit card debt, it can be really, really heavy, because most people, like I said, we talked about earlier, when they're just making their minimum payments, or they're trying to throw another $15-20 at it, thinking it's going to do something, and it just continues to rack up because all these miscellaneous fees that credit card companies charge, is it feels like this weight that you can't get out from underneath, and it feels like this massive pressure, which it puts a lot of strain on families, relationships, you name it. And it's like this: how can I move forward? How can I progress? Life events like that, and then having assets within your, as far as your equity in your home, to get out from underneath there and get that breath of fresh air. It's a good opportunity. It's like, like a fresh start. And it's a mindset shift too at the time, because this is also considering the fact that if we stuck them in a 6.75% rate for 30 years, which it would be fixed, of course. But now once rates go back down, which I think they're projecting, mid to late next year, you can always refinance into a lower interest rate when that time comes. And now maybe it's not costing you $280 more a month. Maybe you're saving $500 a month, and these life lessons that we learned with the credit card debt that we were weighed down by is, okay, well, you know what? Now I'm going to use the credit cards wisely, which also, by the way, when they pay all those credit cards down or off completely, what also happens? Their credit score skyrockets too, So there's so many different benefits to look at when doing something like this. Is, we talk about the car loan in here. That's there. The car loan, well, guess what? That's not going away. That car, at least, the loan will go away, but that's an asset now.
Right.
So some push comes to shove. Well, guess what? Now you have something there for you that you can use as a tool, again, because you're driving something that's owned free and clear and no longer a burden. Now it's a tool. Yep,
absolutely.
So it's really good, like eye opener, and like, aha, like, oh my gosh, what can I really do with my money and the assets that I have? But that's why I think it's really important to share when it comes to how to really use your house as a financial tool to not only move up, but also put yourself in a better situation. And for folks out there that aren't interested in moving up, this also works if you're just going to do like a cash out refi, which my wife and I actually just recently did. And folks thought we were out of our mind when we traded in a 2.75 for 7.5. And that was when I got a deal. That's when I got a deal on my, you know what I mean? So I paid off almost $200,000 worth of stuff between motorcycles and cars, you name it. And we actually save with a higher interest rate. We're still saving $2,000 a month.
Yeah.
Which is crazy.
No, I think this is great. And I love you guys offer the cash out refi too, which, not every buyer is in a position to sell their house, have this equity and turn around and buy. Some people don't want to move. They just need the equity out of the house. And they need to understand that this is an asset for them and they have access to those funds, and not to be afraid of the interest rate. Look at the picture holistically, right? Like reach out to me, run the numbers. Because that's the thing I probably get the most is people are fearful. They're almost fearful of the answer. They're afraid it's not going to be the answer they want. They're afraid they're not going to be able to solve their problem. And so they kind of, right, as humans, I think we have the tendency to stick our head in the sand sometimes and just hope it kind of all goes away.
Yeah, no, I hear you. Well, they're afraid of rejection too, right? That's like, if you really look at the core of like human psyche, is everyone's afraid of rejection,
Right.
and afraid to ask the question because either they don't want to feel stupid or they're going to be told no or whatever it is. But you know as well as I do, like, knowledge is power. What do I have? Do I have options? And if not right now, then when? And that's what, having partners like yourself and I, in their lives to really help guide them as, having their fiduciary mind, goals in mind. That's really who you should be partnering with.
Yep.
Have the big picture. So do you think that people right now, it's a good time? Obviously we looked at the, the refi side and also the move up purchase side when it comes to consolidating debt. Let's talk about housing. Like, should people wait to buy a house right now? Or do you think that, now is the time?
There's always multiple facets to that in any market, right? But right now, our prices are better than they've been in the last 2 to 3 years. We are still, oddly enough, we're still seeing some competitive offers. We had an agent on our team write an offer last week for $20,000 over list price and still didn't win because we were in multiple offers. So that's not happening every day, but we still have a very, very strong housing market in North Texas, and we don't anticipate that changing anytime soon. So going into the market today, knowing what your interest rate is, knowing that you can probably negotiate that purchase price a little bit, get a better price than you could have gotten 18 months or 2 years ago, definitely puts you in a better position than waiting until interest rates finally do drop a little bit, which we do anticipating that happen. We just don't know exactly when. We just know election year coming. So we anticipate that we're going to see some relief there. But if we all sit around and wait for that 6%, 5.5%, and then everybody jumps in at the same time, we are right back in the market that we experienced 2 years ago with not only 15, 20,000 over, we were seeing 100, 200,000 over. I don't anticipate seeing that craziness again, but I do anticipate seeing a lot of competitive offers, people waiving option periods and inspections and, contingencies and pulling cash out of other areas. And we're not as cash flush in America as we were 2 years ago, just due to the economic changes. So people aren't going to be as competitive as we were 2 years ago. So we're going to be fighting each other for these houses again so that we can save 1% or save 1.5 points, where we could get in that market today. We could get the home we want. We're not necessarily competing, especially at certain price points, and know exactly what we're walking into and know that we have the opportunity to, refinance in the future when that rate does drop. We've already gotten into the home, we can afford the home, and now we're actually just going to be putting money back in our pocket every month. The last time you and I chatted and did a video a few weeks ago, we talked a lot about the buy down. And so that's still an option in everything we're talking about. So, people technically could be getting into this home. Let's say it's 7% today. They could be having 5% for year one, 6% for year two, and still refinancing when the time is right here sometime in the next, 12 to 18 months, probably. So there's so many options.
Well, yeah, not only that, but like right now, you said something a second ago where you talked about seeing all these competitive offers come in that, if a house, not to say a house has been sitting, but you have motivated sellers that, want to move up and they're like, they want to do these things. There's a good opportunity to have, those buy downs actually paid for you.
Yeah.
You know what I mean? Where if we were talking a year, 2 years ago, that was not an option.
And in 6 to 12 months, it may not be an option, right? If sellers are getting competitive offers, they're getting multiple offers, they're less negotiable. That's just simple. That's supply and demand. So let's grab those sellers. Let's grab those homes when the seller is negotiable. They don't have people beating down their door. They're on the market 20, 30, 60, 90, 120 days. We haven't seen that in a long time. And we're back in that market, which is really a very stable market for North Texas. It just feels uncomfortable because we got really used to multiple offers in 3 days kind of thing.
You're 100% correct in that. Like without a doubt, I totally agree with you. So I want to show you one last little thing because we just talked about whether people should wait or if they should jump in right now, and you just hit it. You hit the nail right on the head when you talked about it's a whole supply and demand scenario, right? So when supply is low and demand's low, then things kind of tend to sit a little bit. Well, the demand's low because people are afraid. We talked about that a while back when we're going over the consolidation of debt thing and what you can actually do with your equity. But here, let's just look at just a straight up, if we were to wait 6 or 12 months and see what that actually looks like. I'm gonna go ahead and share my screen one more time. All right, so I guess you guys should be able to see my screen. So if rates are coming down, should I wait to buy? Right? You talked about it. Crystal ball does not exist in my office. I don't know if it does in yours.
Oh man, I'd be so much richer if it did.
Right? That would be super sweet. And I would be able to do so many more things for so many more people, but they don't exist. But we do have data, right? We have historical data that tells us a story and then what to expect over the coming years. It was 6 months into a year in this example here. So if we're looking at $1 million purchase, and again, this is in Florida and it's all, state and county specific. So if they were to buy a house today, right? And it was $1 million, that rate right now would be 6.5%. Well, if they waited in hopes that the rates would go down a full percent in 6 months, then, and as equity goes back up, as far as the value goes, you're going to go up about 2%, which is the average appreciation for that area. That's what it's going to look like. And as far as equity goes, and if we waited a year, they're not going to drop as much as everyone, I don't want to say as everyone might think, but they're not going to go down to 2s and 3s like we talked about.
Right. Yeah.
Right. That's the big.
We can all get rid of that expectation right now.
Exactly. Historically average, I think what it'd be 5 to 7% is pretty average nationally.
Yeah.
Here in North Texas, it's a little bit different. I think it's a little bit higher than that, but that's just because we have such a demand out here.
Yeah.
All right. So that's what it's going to look like right there. So getting to the last one right here. So in this slide, Holly, what I was going to show you is if rates do come down, should I wait to buy? Well, this number right here, the 421, this is the payment difference if we went from 6.5% down to 5.5% based on the slide just a second ago. Okay. Yeah. So it's a $421 difference in lower. And that sounds great. Well, I should totally wait, right? Well, let's look about the appreciation. We talked about how prices continue to go up. This might even be a low number right here, Holly, because as rates go back down, you said it a minute ago, what also happens, you have more buyers. More buyers means more competition. More competition means more, I don't want to say aggressive offers, but offers now tend to be 10, 15, 20, you said it, $100,000, $150,000 over asking, which is wild to me, but let's just be conservative. Let's just say the appreciation was only 20 grand. Mm-hmm. Well, the 4,300 right there, that's also your monthly payment that you've been making for the last 6 months, should you buy right now. So realistically, what you're leaving on the table is almost $25,000 by waiting 6 months.
Waiting for that 1% rate drop, is actually costing people money. And I think that has been the big fear that comes out in buyers over and over again over this last year, as we're kind of resettling into this market, is, are we going to crash? Are we in a bubble? I know you even kind of started this video that way, is are we in a bubble? We don't think so. I mean, we really don't feel it. We're not seeing it. We're seeing price reductions, but we're seeing price reductions from that unrealistic top of market. We're not in the same competitive market. So we're not seeing the values go down. We're not seeing issues with appraisals. When the lenders start telling us, oh, we won't lend that amount on that home, that's when we start going, oh crap, right? We're not seeing that. We're not feeling that. We're getting those same prices for homes today that we were seeing 12 months ago.
Yeah,
really in line. I mean, we might see a little bit of a difference because of the lack of competition, lack of buyers in the market, just a little bit of unsettling, but we're not seeing massive drops. We're not seeing big market corrections.
Yeah. Well, I mean, you got to consider too, what caused those other, we'll call them market corrections or, bubbles being burst and all that stuff, all that, what caused those? Obviously what's the first thing that comes to mind is 07, 08, 09. Well, that wasn't a market issue. That was a lending issue.
Right.
And like anything, when there's a problem moving forward, obviously the mortgage business needs to continue. So those things need to be corrected. And so we're not looking at the same, but everyone likes to reference that, which I can understand because it's not talked about fully looking at the whole picture as far as why it actually happened. And looking back even further, if you look in, I think the early 2000s, when there was a kind of a burst too. And again, this is going to be nationally. This is not North Texas, but nationally. Right. You have areas that you have such high inventory and so few buyers. So when you have that much inventory and not a whole lot of buyers, that's going to cause an issue. And so what we're looking at, and the media is going to tell a lot of things. They're going to mostly talk about nationally. They're not going to talk about North Texas. That's why it's super important to, for them to get in touch with, folks like you to really get market specific, super targeted, where they're interested in what's happening in that market opposed to nationally, because it's a different story nationally. Like there are markets that are going down.
Yeah.
But they're not North Texas. I can tell you that.
Exactly right.
I don't know. What do you think? I mean, do you think it's a good time to buy?
I think if somebody needs to buy, they're ready to buy, they're in a position to buy, it's always a good time to be a homeowner. If you do a study and you do a little research and you find out some of the wealthiest people in the world, how they got wealthy, they will almost always reference real estate. If it wasn't their main source of wealth or equity creation, then it's usually a part of it at least. And so there's a reason wealthy people own multiple homes. And they usually own lots of rental properties and things like that become assets, become income streams. It's not a bad market. It's a tough time if you don't understand the ins and outs and the opportunities and the options. So really, we always, and I know you do too, and that's why we do these videos together, is we always like to come from a place of education and really just answering the people's questions, find out if they're in a good position to buy, if it is the right time for them, because there is never a blanket statement that it's a bad time to buy or it's a bad time to sell. Every individual situation is going to play into that.
It's very true. It's very true. And the biggest thing I get, maybe the big takeaway from this video and this conversation really should be, is if you don't know, just call. It doesn't hurt to pick up the phone. I mean, it could be as quick as like a 2 or 3 minute conversation. I've had some that have lasted over an hour, but really just learning, tell me more, because the Google search is like black hole vortex that, right? I mean, there's
that
things
information
that I don't, and then these algorithms that pop in, like, why am I seeing what I'm seeing? Where did this come from? Who said what in my room that is now showing me this and suggesting?
Yeah. And the calculators, there's a lot of mortgage calculators, and that's great. It's a nice quick way for people to go Google. Let's get a quick number. Let's see if this even looks like something I want to do, but it doesn't tell the full story. And that, what we were talking about today, talking about that consumer credit, talking about these blended rates, that tells the full story. So when somebody's able to get on the phone and ask the right questions and then be asked the right questions, if you're having that conversation, I'm assuming it's pretty common that goes to, okay, do you guys have other debt you want to pay down? Like, is there something else you want to do with this equity? Let's look at all your options. And so that changes the conversation from the Google search of what would my mortgage be, XYZ. That's a totally different conversation.
Absolutely. And then what we just discussed earlier today, but kind of the first part of this video, that obviously that applies to people that do have those credit card debts and car loans. If you don't have debt, then obviously it's a different conversation, but that kind of conversation kind of shifts to, okay, should I do like a debt consolidation to purchase an investment property? You know what I mean? There's just because you're not going to consolidate your debt down in your current home and not leave and not go anywhere and save yourself money doesn't mean that you still can't look at that same equity as a tool, which is what it is, to create that generational wealth by getting into investing. And there's still an opportunity for that. So
and that's a great little add-on to what we just talked about is, we don't talk about that a lot. People don't always understand how property investors really do get to 5, 10, 30, 100 homes, 100 doors, right, per se. They don't understand that they're using the equity in those other properties. They're pulling out just that little bit, 20,000, 100,000, depending on what they're about to purchase, and turning around and buying another property with it. And they're basically almost chain linking those together, pulling equity from one to put into the next one, wait a year or two, pull equity from this one to put into the next. And so it's a learning conversation for somebody who is at all interested in becoming an investor. How do I get into investing? I don't have cash sitting around. Well, if you own a home, you probably do have cash sitting around. It's just a matter of accessing it.
Yeah, it's the great multiplier, right? I mean, it's like anything else. Once you start to, it's like creating a snowball, or like, you start small and it just builds and builds. And then a little effort takes, it takes you far in life when you start with the one, then you do the two. And like you mentioned, how many doors you're now an investor of. Now you have that really sweet thing we like to call like mailbox money.
Yeah.
And if you choose to keep working, it's because you love doing what you do. And you probably already do, but you don't have to work if you don't want to. You're actually using your real estate investments to work for you.
Absolutely. Maybe that'll be our next video.
That'd be fun. Investing and how to get into it. I love it. I think it's a great idea.
We'll plan that for later, but Josh, thank you so much for all the information today. Super helpful, a little bit different than what we're hearing across the board. So I always like to put things in front of, you know, our clients, our consumers, our local community, that gives them options and gives them a little more detail on what they could do, how they could get into investing. Is an exciting next video. So I can't wait to dive into that. But anything else you want to add before we jump off?
No, I think it's going to be a great day. I mean, I appreciate having me on, and obviously I love doing these things with you. And you know, like I said, it's a great thing to be able to educate the community about what is possible with real estate, with what they currently have. And I just appreciate you having us on.
Awesome. Well, for everybody watching, Josh's information is down below in the details section. So reach out to us. Let us know if you have any questions. We would love to chat.
Awesome. Thanks, Holly.
Bye, guys.
Bye now.